Welcome back to the deep dive, where we slice through the noise and hand you the crucial insights. For something called stable, these digital assets are anything but boring when you really look under the hood.
Yeah, definitely not boring.
We're talking about a corner of crypto that's been quietly, but, well, rapidly transforming how we think about money. Stuff like high yield opportunities you might not even believe are real, right?
Oh, yeah.
And frictionless global payments that are totally redefining commerce.
Absolutely. And look, today we're completely skipping the stablecoin 101, no basics.
Right, done with that.
Our mission here is to take a proper deep dive into the advanced strategies, the tips, and honestly, the really clever tricks that seasoned users are leveraging right now.
Okay.
We're going to explore these sophisticated earning opportunities that go way beyond just simple lending. We need to understand how stablecoins are revolutionizing international transactions and peer-to-peer payments, like on a scale most people don't really grasp yet. Then we'll peel back the complexities and the immense potential of cross-chain yield farming. And finally, sort of gaze out at where all this innovation is truly headed next.
So if you're ready to peel back those layers and get a real sense of the cutting edge in digital finance, grab your mental scuba gear.
Good analogy.
This deep dive is all about becoming truly well-informed on stablecoins, but in the expert arena. We're going to give you those aha moments, maybe some surprising facts, and hopefully just enough humor to keep you hooked.
Sounds good.
Okay, let's unpack this then. If we zoom out for a moment, it's pretty clear stablecoins are way more than just a less volatile token, right? They're fast becoming these foundational financial rails for the whole crypto ecosystem.
That's right.
But for our listeners, what does that really mean in practice? Like, how do they function as rails in a way that, say, traditional systems can't? And what's the actual impact we're seeing today?
Yeah, that's a crucial question because that railroad analogy, it really is key. It moves stablecoins way beyond just being a simple store of value, which honestly is what most people still think.
Right, just digital dollars sitting there.
Exactly. But their inherent stability, that's the magic. That's what actually unlocks the development of these incredibly complex financial instruments and applications. Things that would be utterly impossible with, highly volatile assets like Bitcoin or Ether for these specific functions.
Makes sense.
Think about it. Without that stable base layer, how could you reliably build sophisticated lending protocols? Or create derivatives markets on-chain? Or even just facilitate basic commerce on a blockchain? You couldn't, really.
Yeah, the volatility would kill it.
So this foundational role, it positions stablecoins not merely as like a part of crypto, but as a critical bridge. A bridge to the broader traditional financial systems.
A bridge. Interesting.
Yeah. We're talking about a brave new world powered by stablecoins. That's maybe a bit grand, but think about near-instant, low-cost payments globally. Think about autonomous AI agents managing commerce, executing transactions without needing a human.
Wow.
Or corporate treasury operations being fundamentally reshaped for speed and efficiency. It's a vision that moves stablecoins from just a niche asset for crypto traders to foundational infrastructure for a truly digital economy, like a global operating system for value transfer.
A global operating system. That's a powerful way to put it. And when you talk about real-world impact, I think the numbers, well, they speak volumes here. We've seen some pretty jaw-dropping stats recently, haven't we?
Indeed. And this is where the wow factor really kicks in, especially for our expert listeners who maybe haven't seen these specific figures. Consider this. In 2024, stablecoin transfer volumes actually surpassed Visa and MasterCard combined.
Wait, really? Combined?
Combined. Think about that for a second.
Again?
$27.6 trillion in stablecoin transfers.
Yeah.
That absolutely dwarfs Visa and MasterCard's combined $7.7 trillion.
That's insane.
It is. And this isn't just some big number for crypto nerds, right? It's a seismic shift in global transactional utility.
Yeah.
It's often happening behind the scenes. Maybe the end user doesn't even realize it's stablecoins moving the money.
Right.
It means stablecoins aren't just a new store of value anymore. They're fundamentally rewriting the rails of global commerce. The implications for, say, payment processors are just staggering.
Yeah, I bet.
And this surge in demand, it isn't just internal to crypto either. It's actually becoming a meaningful new source of U.S. Treasury buying.
How so?
Because the issuers, the big ones anyway, they back their stablecoins primarily with short-term T-bills. So as stablecoins grow, demand for T-bills grows. This expands the global reach of the USD in a completely novel, sort of decentralized way.
That's absolutely wild. It really makes you reconsider what money movement even means today. And what's really fascinating is that this foundational shift, this almost, unimaginable growth we just talked about,
Yeah.
it isn't happening in a vacuum.
No, definitely not.
It's being propelled by this crucial confluence of tech advancement, a growing understanding in the market, and maybe most critically, a dramatic change in perception and policy. It feels like the traditional world is finally waking up to the practical utility,
Yeah.
which leads many to dub this a kind of chat GPT moment for crypto. Stablecoins acting as a catalyst for broader institutional acceptance and becoming a real revenue engine for banks and platforms.
Precisely. That ChatGPT moment label is pretty apt, isn't it? Because it signifies that sudden, widespread recognition of practical value, just like AI's recent public surge.
Exactly.
For years, crypto executives, they often face, well, total uncertainty, maybe even enforcement actions from regulators, just operating in this unpredictable gray area.
Yeah, very risky.
But now we're seeing a massive regulatory shift that's creating a much more predictable operating environment.
Yeah.
And predictability, as you know, that's what institutions crave above all else. So this moment, it truly reflects a maturing of the crypto industry, moving it from the fringes, from pure speculation, towards more integrated financial utility. And this could dramatically speed up stablecoin adoption within traditional finance, or TradFi. Tom Lee, who's a respected voice in finance, he really nailed this. He observed that stablecoins have seen widespread adoption by consumers and merchants. And now, incredibly, banks actually want to offer them.
That's the big shift.
It's a complete flip from skepticism to embrace. And remember, most major stablecoins are backed by short-term U.S. treasuries. They're earning a healthy 4 or 5% yield for their issuers right now.
Okay.
In a normalized interest rate environment like we have, this makes them incredibly attractive as a revenue stream. That fundamentally changes the sentiment among traditional finance leaders. Think about Jamie Dimon's famous skepticism and then his sort of eventual flip-flop. It illustrates the change perfectly.
It's quite a turnaround when you think back just a few years. And that institutional embrace, that shift in sentiment you mentioned, it's being solidified by specific legislative efforts, things that are shaping the actual rules of engagement.
Yeah, the guardrails are going up.
We're seeing key bills like the Genius Act and the Clarity for Payment Stablecoins Act making their way through Congress. These acts are standardizing rules, focusing hard on reserve transparency.
It's crucial.
Absolutely. And critically, providing legal pathways for banks and fintechs to actually issue stablecoins themselves. It almost feels like the U.S. is creating a kind of CBDC by proxy through regulated private stablecoins.
That's a really sharp observation.
Leveraging private sector innovation to extend the dollar's global role rather than issuing a direct central bank digital currency, a CBDC.
You've absolutely hit on a critical strategic point there. And for our expert audience, understanding the nuances of these acts is vital. The Genius Act, which, the Senate is likely to take up, it mandates full backing by short-term assets, things like U.S. Treasury bills and cash deposits.
Okay, full backing.
This isn't just some technical detail. It's foundational for institutional trust. Full backing by highly liquid, low-risk assets like T-bills ensures a robust reserve structure. It mitigates those run risks that plagued earlier, less regulated stablecoin attempts.
Right, avoids another Terra situation.
Exactly. And the Clarity for Payment Stablecoins Act, which already passed committee with bipartisan support, that provides those crucial legal pathways for traditional financial institutions, the banks, the fintechs, to actually enter this space properly.
So it opens the door for them.
It does. This whole regulatory push, it's a delicate balancing act, really. It's designed to maximize the benefits of stablecoins' efficiency, global reach, while simultaneously mitigating the significant risks. Things like inadequate oversight, the potential for runs, regulatory arbitrage, especially with international providers.
Right, making sure everyone plays by the same rules.
Pretty much. It's about ensuring stability and consumer protection without stifling innovation or, accidentally pushing all the legitimate activity offshore.
And this choice, this U.S. strategy to lean on private stablecoins rather than going for a direct CBDC, that's a really interesting strategic move, isn't it?
Yeah.
What are the broader implications, especially in, global competition?
It absolutely is a strategic choice. And it starkly contrasts with, say, the EU's focus, which seems more geared towards central bank digital currencies for financial stability.
Right, different philosophies.
Completely. It highlights these divergent EU and U.S. perspectives on digital currency strategies. The U.S. is essentially saying, let the private sector innovate, let them build the rails, but we'll provide the regulatory guardrails to ensure dollar stability and global reach.
Mm.
This divergence will undeniably impact the global competition for digital dollar dominance. And get this, the Treasury Secretary, Scott Bessent, has even highlighted stablecoins' potential to reduce the national debt.
How? By increasing demand for treasuries.
Exactly. By increasing global demand for U.S. Treasury bonds used as backing, he projected the market could reach $3.7 trillion by 2030 with legislative support. Think about that. A novel mechanism possibly helping manage national debt.
Wow. Okay.
And it's not just the federal level. States like Wyoming are also pursuing dollar-backed stable tokens. Governor Mark Gordon highlighted their potential to hedge against monetary supply growth. So this isn't just theory. It's actual legislative action and strategic positioning for the future of the dollar.
Okay, so with this enhanced legitimacy, this incredible regulatory momentum building, the opportunities for earning with stablecoins are becoming incredibly sophisticated, much more than just holding them.
Oh, absolutely.
Let's delve into the advanced strategies now. We're seeing this full spectrum of stablecoin yield farming, right? From relatively low risk liquidity provision all the way up to high return, but definitely higher risk leveraged positions.
Range, yeah.
So this includes things like stablecoin liquidity provision that's typically offering, 5-20% APY on platforms like Curve, Cave, Compound, generally seen as low to medium risk.
Correct.
Then you've got blue chip token farming. This involves established cryptos, maybe offering 10-50% APY on places like Uniswap, SushiSwap, Balancer, but that comes with medium risk.
Definitely medium risk there.
And let's not forget yield aggregators. These automate and optimize the returns, often making the whole process more accessible, even for sophisticated users who don't have time to manage it constantly.
Exactly. It's crucial, though, to understand that while stablecoins inherently reduce the volatility risk of the underlying asset itself,
Right, the dollar peg.
yield farming introduces its own distinct set of complexities and risks. You're not just betting on the stablecoin holding its peg. You're interacting with smart contracts, you're subject to protocol economics, and often you're dealing with leverage.
Okay, so layers of risk.
Layers. Different strategies cater to different investor profiles and risk tolerances. For example, conservative investors may be beginners in DeFi yield. They might gravitate towards stablecoin liquidity provision on platforms like Curve. It's got lower volatility, steady returns, kind of a set it and forget it, passive income stream.
Makes sense for some.
More moderate risk takers, or maybe long-term holders, they might look at blue chip token farming. That offers exposure to established projects, but it carries higher impermanent loss risk, which we definitely need to dig into later.
Yeah, impermanent loss is key.
And the increasing institutional participation we talked about earlier, that will certainly impact these strategies. Will the influx of bigger capital flatten some of the most lucrative sort of alpha opportunities as these larger players soak up the available yield?
Or maybe create new ones.
Or will it create entirely new, perhaps more stable avenues for yield as protocols mature to actually accommodate these larger players? That's the really fascinating question for the next few years, I think.
Okay, so we've touched on liquidity provision and aggregators. Let's dive deeper into some of the specific mechanics that drive these yields, because it's definitely more nuanced than just sticking your stablecoins in a, crypto savings account.
Agreed. Stablecoin liquidity provision, fundamentally, it means depositing your stable assets into pools. Platforms like Curve, AA, Compound. You do this to earn interest, either from trading fees generated by swaps in the pool or from lending demand if it's a lending protocol. That's a pretty direct way to generate passive income.
Right.
The mechanics are quite clever. These automated market makers, AMMs like Curve, they allow users to earn those trading fees just by providing liquidity. And what's especially compelling about stablecoin to stablecoin pools, like say a USDC, USDT pool on Curve, is that they minimize that impermanent loss risk we mentioned, because the assets are theoretically pegged to the same value, right? So there's much less relative price divergence between them.
Okay, that makes sense. Minimizing IL.
Now, for those looking to optimize, these yield aggregators, like Urine Finance, Beefy Finance, they are a potential game changer. You deposit your assets, and the aggregator intelligently allocates them across various farming opportunities.
So it does the work for you.
Exactly. It's constantly compounding your earnings by automatically reinvesting them. This not only diversifies your exposure across multiple protocols, which is good risk management, but it also simplifies a process that can be incredibly complex and time-consuming to manage manually.
So these aggregators are essentially like an automated DeFi portfolio manager, always hunting for the best yield and auto compounding for you. That sounds incredibly efficient.
That's a good way to put it. Consider an Ivan compound. There you could just supply USDC and earn interest, historically maybe 4 9%. That's your basic layer. You're in a beefy, on the other hand. They manage the entire process of finding and compounding the highest available yield across various lending platforms and liquidity pools. They're constantly executing complex strategies behind the scenes, harvesting rewards, swapping tokens, reinvesting, all without you needing to lift a finger.
Hmm.
Looking ahead, as DeFi infrastructure matures, it's reasonable to speculate, whether aggregators will just become the default method for earning stablecoin yield for many people,
Yeah.
abstracting away all the underlying complexities.
But that raises questions, right, about transparency and control if you're relying on these automated systems.
It absolutely does. That's the trade-off. You gain efficiency and potentially higher compounded returns, but you lose some direct control and rely more on the aggregator's strategies and security. But for many users, the efficiency gain is just undeniable.
Okay. Now, beyond just generic liquidity provision, the very design of some innovative stablecoins is creating entirely new yield opportunities. This is where we get into this new class called yield-bearing stablecoins, or YBS.
Right, the native yield concept.
Athena's SUSD is a prime example people talk about. It generates yield through what's known as a cash and carry trade. Can you unpack that a bit? It sounds complex.
It is a bit complex, but think of it as a market-neutral strategy. You're essentially trying to capture a funding rate differential in the crypto derivatives market. Athena does this by simultaneously shorting ETH perpetual futures contracts while holding an equivalent amount of spot ETH, or staked ETH derivatives usually.
Okay, short futures, long spot.
Exactly. The goal is to create a relatively stable yield that's largely insulated from the underlying price swings of Ethereum itself. It aims to capture the premium or funding rate paid by longs to shorts in the perpetual futures market without taking a directional bet on ETH's price going up or down.
Gotcha. So it's harvesting that funding rate.
That's the core idea. These YBS models are truly at the cutting edge right now. Athena's SUSD, it relies on that funding rate from the perps plus the staking yield from the underlying ETH collateral to provide returns to the people who stake USD to get SUSD. And this is a very different business model compared to, say, Tether. With Tether, all the revenue generated from their backing assets, those T-bills mainly, that's retained by the issuer. It doesn't get distributed to USDT holders.
Interesting distinction.
Another really intriguing development is MakerDA's USDS. This is an evolution from their long-standing DAI stablecoin. USDS incorporates tokenized short-term U.S. Treasury bills directly into its reserve.
So RWA is in the backing.
Exactly, real-world assets. This offers a built-in yield directly via their day savings rate, the DSR. It effectively bridges DeFi and TradFi, optimizing its collateral structure with RWAs like Treasury bills to appeal directly to institutional demand.
Making me more TradFi friendly.
Precisely. Athena talks about this convergence vision, aiming to merge DeFi, CeFi, and TradFi through USD, providing a high-yield, crypto-native dollar product tailored to asset managers. And its growth has been explosive. Athena became the second fastest dApp in history to reach $100 million in revenue just 251 days. And it now dominates certain parts of DeFi, accounting for over 50% of Pendle's total value locked, for example. Some of these YBS have delivered yields greater than 8% in recent months, which is obviously very attractive.
Yeah, definitely.
So if traditional interest rates stay low, or maybe even decrease again, the success of these YBS models could significantly impact the broader stablecoin market. We might see a whole proliferation of other algorithmic-like stablecoins using similar hybrid models. It's truly a new frontier for stablecoin economics.
Okay, now for those looking to potentially amplify their returns even further, though definitely amplifying the risk to leverage yield strategies are becoming more common.
Yes, the lepping strategies.
It's quite similar to a traditional finance carry trade, right? You deposit stablecoins into a lending protocol, then you borrow other stablecoins against that collateral. Then you swap the borrowed stablecoins back into the original asset, or maybe another stablecoin in your strategy, and redeposit them, creating this loop. Each loop effectively increases your exposure to the underlying stablecoin yield. So you're basically using your stables as collateral to borrow more stables, which you then put back to work earning yield.
That's the basic mechanism. While this strategy does amplify returns, sometimes quite significantly.
Which is the allure.
Right. But it's absolutely critical to understand that it also proportionally amplifies the risks. The main dangers are liquidation if your collateral value drops too far, which can happen if a stablecoin temporarily depegs, even slightly,
Yeah.
or if the borrow rates on the stablecoins you're borrowing suddenly spike, making your whole position unprofitable or even pushing you towards liquidation. DeFi platforms typically enforce over-collateralization, meaning you have to provide more value in collateral than you borrow.
Right, the safety buffer.
But if your collateral ratio falls below certain predetermined safety thresholds, your position can be automatically liquidated. Poof, gone. So when pursuing these kinds of strategies, it's absolutely essential to, as you said, sanity check the base layers you're using. For an expert user, this isn't just about knowing the loan-to-value ratios or liquidation thresholds. It's about understanding their interplay.
Like how they work together.
Exactly. Take OV's E-mode, for instance. It allows for higher LTVs on highly correlated assets, like different stablecoins. That's powerful for capital efficiency, lets you borrow more.
Sounds good.
But it inherently means your liquidation thresholds become much, much tighter. This demands a deep understanding of how the asset pricing oracles feed data into the protocol. A single glitch in an oracle, a sudden volatile wick down in price, or a miscalculation of your LTV could very quickly cascade into a full liquidation event.
So high efficiency, but walking a tightrope.
Precisely. As institutional capital flows more into DeFi, how these leverage strategies evolve will be fascinating. Will professional asset managers develop even more sophisticated risk mitigation tools? Or will the inherent volatility and, frankly, the composability risks of crypto markets always keep these strategies firmly in the high-stakes category? Time will tell.
That's a really important point about truly understanding the underlying mechanics, not just chasing the headline APY. Now, speaking of risk, a core concern in many yield farming scenarios is impermanent loss, or IL.
Ah, yes, IL. The bane of LPs.
But stablecoins, just by their nature, offer unique ways to mitigate this. So just quickly, impermanent loss happens when the price of tokens you've put into a liquidity pool changes relative to each other, right? Which can erode your returns compared to just holding them.
Right.
However, stablecoin to stablecoin liquidity pools, like, say, a USDC DAI pair on an AM-like curve, they're specifically designed to minimize this risk because both assets are, in theory, pegged to the same value, the dollar.
Right. The fundamental mechanism of IL is this. Liquidity providers, LPs, typically deposit equal values of two tokens, often 50.50. If the price of one token diverges significantly from the other after you've deposited, the AMM rebalances the pool. This means when you withdraw, you might end up with more of the token that went down in price and less of the token that went up, resulting in a lower total dollar value than if you had simply held the original assets outside the pool.
Okay.
For instance, imagine you deposit into an ETHUSDC pool when 1 ETH equals 1,000 USDC. You put in 1 ETH and 1,000 USDC. If ETH price then doubles to 2,000 USDC, the pool needs rebalancing. Arbitrageurs will add USDC and remove ETH until the pool reflects the new price. If you withdraw then, you'll get back less ETH and more USDC than you put in, and the total value might be less than if you just held your 1 ETH and 1,000 USDC separately. That difference is impermanent loss.
Got it. But with stablecoins?
With stablecoin pairs, like USDC, USDT, that price divergence is theoretically minimal because they should both stay pegged to $1. So the impermanent aspect of the loss is significantly reduced. However, and this is crucial, depegging events, even temporary ones, can still introduce this risk. We saw this with USDC during the Silicon Valley Bank crisis. It briefly depegged, causing a temporary but significant divergence from USDT and DAI, leading to IL for LPs in those pools.
Right, so not zero risk, but much lower.
Much lower, typically. Platforms like Curve Finance explicitly cater to this, allowing users to earn fees without donating your stack to impermanent loss by focusing on pools where assets rhyme. Things like stables, liquid staking tokens like Steth and ETH, or wrapped versions of the same asset.
Okay.
The question for the future is whether innovations in AMM design, like concentrated liquidity in Uniswap v3 or new models, will further reduce IL even for volatile pairs, or if stablecoin LPs will just remain the preferred go-to for more risk-averse yield farmers. Probably a bit of both.
So stablecoin pools are kind of like the safe harbor for liquidity providers in the often stormy seas of DeFi yield. Now, while decentralized finance offers all these innovative strategies, it's also worth pointing out that traditional centralized finance, or CeFi platforms, are still offering pretty competitive stablecoin returns.
They certainly are.
Platforms like Nexo, U-Haul, or maybe others, They provide attractive APYs on stablecoin deposits, often with flexible terms or loyalty bonuses if you hold their platform token.
Yeah, the rates can look very good.
Nexo, for example, offers up to 12% APY, plus those Nexo token bonuses, and they talk a lot about their insurance system, up to $375 million.
Mm-hmm.
uHodler goes even further, advertising up to 18% APY on USDC, USDT, and DAI, paid weekly with no lockup period, which sounds very appealing.
It does sound appealing, but these CeFi options, they come with a very clear set of trade-offs, and it's essential for expert users to understand them fully.
Right, no free lunch.
Exactly. While they often offer high yields and a much simpler user experience, easier onboarding, maybe insurance features, they reintroduce counterparty risk and centralized control.
Okay, explain that.
You are fundamentally relying on the platform's solvency, their business practices, their security, and their transparency. Unlike DeFi, where you interact with code you can, in theory, audit, here you're trusting company. A third party holds your funds.
Right, not your keys, not your coins, applies here.
Precisely. Jurisdictional access can also be a factor. These platforms aren't available everywhere due to regulations. Now, Nexo's $375 million insurance and uHodler's no lockup period are significant draws, especially combined with those high APYs. They make them appealing for users who prioritize simplicity and maybe that perceived security of a company name. However, it's crucial to categorize these as medium CeFi risk because of that inherent centralization and counterparty risk.
No.
And as stablecoin regulation solidifies globally, a key question arises. Will these CeFi platforms face stricter oversight on their reserve management and lending practices?
Could that impact their ability to offer those high yields?
Potentially, yes. If regulations require higher reserve ratios or limit certain lending activities, it could squeeze their margins and reduce the APYs they can offer. Or will their user-friendliness just continue to attract users who prefer a more managed, albeit centralized, approach to earning stablecoin yield? It's that fundamental tension again. Convenience versus decentralization and custody.
That's a great way to frame the trade-offs. Okay, let's shift gears a bit. Beyond just earning yield, stablecoins are making really significant waves in how money actually moves around the globe.
Oh yeah, huge impact here.
They're fundamentally transforming cross-border transactions by directly addressing those long-standing pain points in traditional payment systems. We're seeing reduced costs, much faster settlements, and quite remarkably, a real increase in financial inclusion, particularly in crucial corridors like US-Africa and US-LATAM. It's genuinely changing lives.
This is arguably one of the biggest areas of impact, and frankly, it's where stablecoins shine brightest for practical, real-world utility, beyond just crypto trading or yield.
Why are traditional transfers so bad?
Well, traditional international transfers are just notoriously slow and expensive. You've got high fees, multiple currency conversions often at poor rates, and these complex correspondent banking chains involving multiple intermediary banks, each taking a cut and adding delays. It can take days for funds to clear.
Right, I've experienced that. Painful.
Exactly. Stablecoins, assuming you have the right infrastructure wallets, maybe custody providers, on-off ramps they could facilitate near-instant receipt, and access to funds by the counterparty, often within minutes, sometimes seconds.
Wow.
This is an absolute game changer for populations that have historically been excluded from dollarized systems or people living in economies struggling with high inflation and currency devaluation. It offers a lifeline, a way to preserve purchasing power.
And companies are building on this.
Big time. Companies like Circle, the issuer of USDC, are really at the forefront, offering innovative B2B solutions. And look at Stripe, a massive traditional payment player. They acquired Bridge, a stablecoin orchestration platform, back in February 2025. And now they're rolling out stablecoin accounts in 101 countries.
101 countries. That signals mainstream intent.
Absolutely. It hints at widespread adoption that really transcends the crypto niche. We're already seeing significant volume. Some reports suggest about 10% of cross-border remittances are now through stablecoins and cryptocurrencies. Platforms like Bitso in Latin America are processing up to 10% of remittance volumes on the Mexico-US corridor using stablecoins. That shows real trust and adoption.
And the cost savings involved are truly astounding, aren't they, when you contrast it with traditional banking?
They absolutely are. It's almost hard to believe sometimes, to put some numbers on it. Traditional bank-initiated international payments can eat up, on average, 13.65% of the principal amount when you factor in all the fees and FX conversions.
13%. Ouch.
Yeah. Stablecoin transaction costs, in stark contrast, can be as low as, say, 0.01 cents per transaction on an efficient layer 2, or maybe 3 to 6 points on a busier chain like Tron during peak times. But even that higher end is pennies compared to the percentage points lost in the old system.
It's not just a marginal improvement, it's an order of magnitude difference.
Exactly. So the big question now is, will stablecoins eventually disrupt the entire correspondent banking network? Will they force traditional banks to adapt or face becoming obsolete for these kinds of transfers?
Or will banks just integrate them?
Or will traditional banks find ways to integrate stablecoins as a new, more efficient layer within their existing frameworks? We're likely to see a hybrid approach for a while, but the pressure for change is just undeniable. The efficiency gains are too massive to ignore.
And this global utility, it isn't just for large transfers or remittances, right? It's empowering everyday transactions too.
Correct. Stablecoins are increasingly being used for daily needs. Things like retail purchases, paying bills, simple peer-to-peer transfers between friends or family, especially, again, in emerging economies that are grappling with high inflation and currency devaluation.
Right, where holding local currency is risky.
Precisely. Data suggests that over 40% of stablecoin users in these markets rely on them for their actual daily financial activities, not just speculation.
So what's the why behind that level of adoption for daily use?
It's really compelling, and it's driven much more by necessity than by hype. Stablecoins offer a practical solution for preserving purchasing power when your local currency is rapidly losing value. They provide a digital, dollar-denominated asset that can be transacted directly, person to person, efficiently. It moves way beyond speculation to deliver tangible, everyday utility.
Can you give some examples?
Sure, look at Turkey, a country facing persistent inflation challenges. Stablecoin purchases there amounted to $38 billion. That's equivalent to 4.3% of the country's entire GDP in the 12 months leading up to March 2024.
Wow, 4.3% of GDP. That's huge integration.
It's massive. Or look at northern Nigeria. Users there are leveraging payment apps like MiniPay, which runs on the CeeLo blockchain, for essential daily tasks. Buying mobile data, paying bills, shopping online or locally, even sending instant cash gifts to family. It's just woven into their daily financial lives. Platforms like GoCrypto also demonstrate this real-world adoption. They enable users to pay with cryptocurrencies at local and online stores and connect them to thousands of GoCrypto merchants worldwide.
So the merchant side is growing too.
It is. And as more fintech companies integrate stablecoins like Bridge, offering USD native banking as a service for non-US tech startups, we could expect to see the acceleration of these frictionless and borderless neobanks. Banks tailored to serve local needs in underserved regions, creating truly inclusive financial ecosystems powered by stablecoins.
It paints a vivid picture of how stablecoins are solving real-world problems for real people, bypassing broken systems. However, there's always a however.
Always a hurdle somewhere.
Getting stablecoins into and out of the traditional financial system, that remains a critical bottleneck, doesn't it? Especially across borders. We're talking about the crucial role of on-ramps and off-ramps.
Yes, absolutely critical.
While the stablecoin transfers on the blockchain networks are nearly real-time and incredibly low cost, that process of off-ramping, converting the stablecoins back into local fiat currency that people can actually spend easily everywhere, that's still a significant challenge.
It really is. It's often the weakest link in the chain right now.
Why is it so difficult?
It's largely due to a limited number of reliable, well-capitalized liquidity providers in many regions, combined with fragmented and sometimes unclear regulation around these crypto-to-fiat conversions.
Okay.
So the low blockchain transaction fees are only part of the story, as you rightly pointed out. The end-to-end cost and speed, from fiat in one country to usable fiat in another, can be significantly impacted by the friction and cost of that conversion process on either side of the blockchain transfer.
Right, the entry and exit points matter.
Hugely. While off-ramp liquidity and FX solutions are emerging, you've got companies like Bitso, Paxos, Circle working on this, plus partnerships like MoneyGrams with CompoSecure trying to bridge the gap. Their coverage is still quite limited, especially once you get outside major financial hubs or specific remittance corridors.
So it works well in some places, not so well in others.
Exactly. And this friction, the cost of off-ramping, it can add anywhere from 4% to maybe even 10% to the overall cost of remittances, depending on the country and the method used. That eats significantly into the savings compared to efficient, albeit perhaps slower, dedicated services like Wise.
Can you illustrate that?
Sure. Think about Maria sending $200 from the U.S. to her family in Mexico. The USDC transfer itself on the blockchain might cost pennies and take seconds. But her family then faces additional costs and potentially complexities when trying to convert that USDC into usable Mexican pesos locally. It might involve going through a specific exchange, dealing with withdrawal limits, paying conversion fees.
Yeah.
It's not always seamless.
So it's not a minor inconvenience, it's a real barrier.
It's a critical point of friction that definitely hinders broader mainstream adoption. The big question is how this evolves. As regulatory frameworks mature globally, and as institutional involvement increases, will we see an explosion of compliant, liquid, and efficient on-off ramping services worldwide?
That would be the dream scenario.
It would make stablecoins truly competitive with traditional payment rails end-to-end, not just on the blockchain leg. And what role will major payment providers like Stripe, with their global stablecoin payment capabilities, play in actually bridging this crucial gap? It's really a make-or-break area for broader, seamless adoption.
That makes perfect sense. Yeah, that last mile is always the hardest, isn't it? Now, shifting focus slightly, bridging stablecoins between different blockchains is another advanced technique. It's opening up new opportunities, but also introducing its own unique complexities.
Right, the multi-chain world.
This brings us to the imperative of cross-chain interoperability. Cross-chain yield farming involves leveraging the ability of assets to move between different blockchains, say, from Ethereum to Solana to Base, to farm yields across multiple platforms simultaneously.
Yep, chasing yield across ecosystems.
This trend allows for more diverse investment strategies, maybe better risk management by not having all your eggs in one blockchain basket.
Exactly. You've hit on a fundamental aspect of the multi-chain future we're clearly heading towards. The blockchain ecosystem, despite its whole decentralized ethos, has historically been quite fragmented. You have these distinct layer ones, Ethereum, Solana, BNB chain, etc., and now a growing multitude of layer twos built on top of them. Base, Polygon, Avalanche C-Chain, Arbitrum, Optimism.
It's a complex landscape.
It really is. True cross-chain interoperability, the ability for assets and even data to flow seamlessly between these different environments, is absolutely essential to unlock the full potential of DeFi. It grants users access to a much broader array of decentralized applications, dApps, tokens, and services, enhancing capital efficiency and finding new opportunities.
And the potential impact.
Huge. Imagine a future where the dollar divided across dozens of ledgers, as some put it, becomes less fragmented, where overall liquidity increases because capital is entrapped in silos. That leads to deeper markets, potentially more stable yields. Projects are already working on this. Thorchain, for example, enables native asset settlements across major networks like Bitcoin, Ethereum, BNB Chain, Avalanche, Cosmos Hub, without needing wrapped versions of the assets.
So no wrapped Bitcoin, actual Bitcoin swaps.
Yep. Exactly. Similarly, Stargaze simplifies asset transfers with its liquidity transport protocol, allowing for direct transfers of native assets between the supported chains. This kind of tech is foundational to a truly integrated digital financial system, where your assets aren't just locked into a single chain's ecosystem.
And the critical tools enabling all this interoperability are these cross-chain bridges. These sound like revolutionary solutions, allowing the transfer of assets and data between completely different blockchains.
They are pretty revolutionary, yeah.
They bridge the gap between these otherwise isolated ecosystems. But it's crucial to understand that their security and legitimacy are absolutely paramount, especially given some of the very large historical bridge hacks we've seen, millions lost.
Yeah, bridge security is non-negotiable. When we talk about bridges, it's about how they function at a high level. Mechanisms like locking assets on the source chain and then minting wrapped versions on the destination chain.
Like wrapped ETH on Polygon.
Exactly. Or facilitating native asset swaps, maybe using protocols like Thorchain or Stargate we just mentioned. However, the security aspects are what truly matter, and thankfully they've evolved significantly from the early days.
How so?
Well, leading bridges, like Chainport for example, they now employ multi-layered security infrastructure. This includes storing the vast majority, maybe 95%, of bridged funds in cold storage wallets, often provided by industry leaders like Gnosis Safe or Fireblocks.
Okay, minimizing hot wallet risk.
Right. They also incorporate advanced security measures like multi-party computation or MPC, where multiple independent parties need to cooperate cryptographically to sign a transaction, preventing a single point of failure, and multi-signature or multi-sig functionalities requiring multiple signers.
Layers of protection.
Layers. MetaMask's Bridge Aggregator is another good example of progress. It's designed to find fast, cost-effective routes across various bridges for the user and offers cross-chain swapping, which is really neat. It means you can seamlessly swap, say, ETH on Ethereum to USDC on Polygon, all in a single transaction interface. It handles the bridging and swapping for you.
That simplifies things a lot. So for users navigating this, what are the key tips?
The key tips are pretty clear. 1. Stay secure. Always prioritize using platforms with strong public security audits and a proven track record. Avoid new, unaudited bridges. 2. Cut costs. Bridge fees can vary, and network gas fees fluctuate. Try trading during off-peak hours and use bridge aggregators to compare fees across different providers. 3. Monitor markets. Use tools like Bigjit Wallet or OKX Wallet, which often integrate bridge aggregation and portfolio tracking, to keep an eye on liquidity on different chains and potential arbitrage opportunities that bridging might enable.
It seems like the technology is maturing rapidly then. As bridge tech advances, what role will these intent-centric interfaces play? We're starting to hear that term more. And how will security innovations impact institutional adoption?
That's a great question, and it really speaks to the future of user experience, or UX, in this whole cross-chain space. Intent-centric interfaces, the idea is to simplify these complex cross-chain movements dramatically for the end user.
How would that work?
You basically express your desired outcome, your intent. For example, I want to move $100 worth of ETH from Ethereum to Solana and deposit it into the X lending protocol there to earn yield.
Okay, state the goal.
Right. And the system, the interface or protocol, then figures out the most efficient, secure sequence of bridges, swaps, and transactions needed to achieve that goal automatically. It abstracts away a tremendous amount of complexity from the user. They don't need to know which bridge to use or which DX to swap on.
That sounds like a huge leap forward for usability.
It really could be.
Yeah.
Furthermore, innovations like Chainlink CCIP, their cross-chain interoperability protocol, they're aiming for what they call the fifth level of cross-chain security.
Yeah.
This implies a highly robust, provably secure standard for interoperability. And that level of security is what will be absolutely critical for widespread institutional adoption, enabling major players to move significant capital across different blockchains with confidence, transforming these once isolated ecosystems into a truly interconnected financial web.
Okay, so the tech is getting smarter. Now, as these cross-chain strategies inevitably grow in complexity, artificial intelligence is starting to step in to help optimize the process.
Yeah, AI entering the DeFi fray.
Platforms like SparkleX are leveraging AI to simplify things like revenue management and optimize cross-chain yield farming. These AI-powered cross-chain yield optimizers use intelligent algorithms to automate those real-time micro-decisions across major DeFi protocols and blockchains. It sounds almost like something out of a sci-fi movie.
It definitely feels that way sometimes, but the utility is very real. This is a powerful application of AI to solve a genuine problem. The sheer dynamism and complexity of managing DeFi yield positions, especially across multiple chains.
Can you give an example?
Sure. Consider an advanced ETH farmer. They might be earning a great 20% yield on a leveraged position on Pendle in the morning, but by the evening, due to sudden market shifts, changing funding rates, or fluctuating borrow costs, they could be facing liquidation risk. Manually managing such a position, constantly monitoring and adjusting across multiple chains and protocols, it's practically a full-time job requiring deep expertise.
Right, very intensive.
SparkleX and platforms like it are designed to automate these ever-changing micro-decisions in real time. The AI automates tasks like range selection for concentrated liquidity pools, using historical volatility and on-chain depth data to try and keep your capital deployed in the optimal price range.
Okay, keeps the liquidity working.
It also handles rebalancing. That means automatically collecting earned fees, potentially shifting the position's range, and redeploying assets. Often doing this in batch transactions across multiple users to reduce gas costs for everyone.
Efficiency gains there too.
And crucially, it takes care of auto-compounding, automatically reinvesting earned fees and any incentive tokens back into the position to maximize that exponential growth curve from compound interest.
So it's essentially an autonomous co-pilot for your complex yield farming activities. What about the security of these AI optimizers? That's always a big concern when you start handing over control, even limited control.
That's a vital point, and arguably the most important one. Security must be paramount. With SparkleX's Copilot, for instance, they emphasize that its permissions are clearly limited. The authorized operations are restricted to things like rebalancing the pool, harvesting fees, auto-compounding. Critically, it cannot execute withdrawals of the underlying capital.
Okay, so it can manage but not steal.
That's the idea. The AI can manage your active positions but cannot just run off with your funds. Furthermore, the automation is user-enabled. You have to turn it on, and it can be paused or stopped at any time, giving the user ultimate control. And importantly, it only interacts with whitelisted and audited protocols, which helps mitigate smart contract risk from the underlying DeFi platforms it uses.
And transparency.
All operations performed by the AI are logged transparently on-chain, ensuring auditability and accountability. The potential here is really significant, enabling retail users to potentially access institutional-grade, highly complex yield strategies with zero manual operation, fully automated, multi-chain compound interest returns. It could truly democratize access to sophisticated yield generation.
Fascinating. It'll be interesting to see how these AI tools evolve, maybe predicting market movements or even regulatory changes in the future, offering even more dynamic optimization.
That's definitely the direction things could head, moving beyond just reactive management based on current conditions to more predictive strategies based on analyzing vast amounts of data. But that also introduces new layers of complexity and potential risks, of course.
Right. Now, despite all these amazing technological marvels, AI optimizers, secure bridges, the cross-chain space still faces significant regulatory challenges. That seems to be a recurring theme.
Unfortunately, yes, regulation lags innovation, almost always.
Cross-chain transactions, by their very nature, expose profound complications for regulators, particularly when it comes to enforcing rules like the Financial Action Task Force's travel rule. That's the one requiring financial institutions to share originator and beneficiary details for transfers above certain thresholds.
Exactly. And in bridges and decentralized exchanges, DX swaps, they often lack the built-in compliance logic to easily handle this, mainly due to their decentralized, non-custodial nature. This creates what many call a compliance void.
A void regulators don't like.
Definitely not. Now, while AI analytics and smart contract plugins can be developed to auto-flag suspicious movements or potentially enforce rules on certain permission systems, they often rely on centralized data standards or oracles. And that clashes fundamentally with the permissionless, open nature of most public blockchains and decentralized protocols.
A fundamental conflict.
Plus, you have the added complexity of divergent rules across different jurisdictions. The EU's MiCA regulations bring uniform standards, which is helpful, but they primarily apply to registered virtual asset service providers, VASPs, and authorized platforms. They don't necessarily cover purely decentralized protocols or individual users interacting directly.
These gaps.
Meanwhile, in the U.S., OFAC, the Office of Foreign Assets Control, has shown its willingness to impose strict penalties, with digital banks facing potential fines of over $200 million for anti-money laundering (AML) lapses if they don't comply adequately. That puts real pressure on any regulated entity touching crypto. And the UK regime is aiming for an even broader AML lens for DeFi, trying to bring decentralized protocols themselves under its purview, which is technically very challenging.
So the big challenge is,
How do regulators possibly reconcile the permissionless nature of global blockchains with the absolute need for financial oversight, especially when it comes to combating illicit finance, like money laundering or sanctions evasion? Will the industry manage to develop truly decentralized compliance solutions that somehow satisfy regulators without compromising the core principles of decentralization?
or will regulation just push activity elsewhere?
Or will regulatory pressure inevitably push more activity into permissioned, more centralized environments, effectively limiting the Wild West, innovation at the edges aspect of cross-chain DeFi?
Okay.
It's a fundamental tension that will absolutely shape the future architecture of this entire space. No easy answers here.
It seems like these trends in cross-chain activity are just one facet of the broader innovation happening in the stablecoin space, which, as we've seen, just continues to evolve at this incredible pace.
Relentless pace, yeah.
So let's look out towards the horizon now. What's next? What are the key drivers of future innovation? It seems like increased institutional capital, a real focus on user experience, UX, and sophisticated data analytics are key themes.
Those are definitely three major drivers.
We're seeing the emergence of these crypto-native asset managers, right? Firms deploying significant capital across advanced stablecoin and DeFi strategies.
Yes, dedicated on-chain asset managers.
And at the same time, user experience is becoming paramount. Users seem to be prioritizing reliability, predictability, simplified interfaces over just blindly chasing the absolute highest APY, which might come with hidden risks or complexity.
That's a sign of maturation, I think.
And underpinning all of this are data-driven markets, leveraging tools like vaults.fi or artemis.xyz for deep insights into capital behavior, liquidity cycles, cross-chain flows. really understanding what's happening under the hood.
Exactly. This confluence of factors is genuinely shaping the next evolutionary phase of DeFi yield and stablecoin utility.
Right.
Institutional capital brings those larger capital inflows, which, yes, can sometimes compress yields, but also leads to more stable yields and increased legitimacy overall.
Right, attracts more infrastructure.
We're seeing this play out with firms like Rest7 Capital, Gauntlet, Steakhouse Financial. These crypto-native asset managers have grown their collective on-chain capital base from roughly $1 billion to over $4 billion just since the start of 2025. And the managed total value locked, TVL, of major strategy curators has nearly reached $2 billion in just the Morpho protocol alone. That's serious capital being professionally managed on-chain.
Wow. And this professionalization demands better UX.
Absolutely. Simplified front ends, gasless transactions where the protocol pays the gas for the user, and those intent-centric interfaces we talked about, they're crucial now because they reduce friction, they build trust, and that leads to ongoing capital stickiness in DeFi protocols. Users are frankly tired of clunky, fragmented interfaces and unpredictable high gas fees.
Yeah, usability is key for wider adoption.
And on the data front, having standardized aggregated vault data, being able to analyze stablecoin flows between chains, tracking cross-chain transfers, this provides a comprehensive picture. It allows sophisticated users and managers to look beyond the surface-level numbers, understand the deeper market currents, and hopefully identify true, sustainable alpha rather than just chasing transient high-risk yields.
So this suggests a future where DeFi becomes so, abstracted and integrated that users might interact with yield-generating protocols without even realizing they're using blockchain on the back end.
That's definitely a potential end game for mainstream adoption. What does that mean for the whole democratization of finance idea if the underlying technology becomes essentially invisible, just an efficient back-end infrastructure? It could potentially open up DeFi participation to billions more users who don't know or care about private keys or gas fees.
That's a compelling vision, the invisible revolution. Now, this convergence you mentioned, it also extends to how stablecoins interact with real-world assets, RWAs.
Yes, the tokenization trend is picking up steam again.
The tokenization of RWAs, things like securities, real estate, maybe even art or collectibles, it's gaining significant traction, promising less friction in asset sales, fractional ownership, better management. This seems like a key part of that broader convergence trend, merging DeFi, CeFi, and TradFi.
You're absolutely right. Tokenization is essentially the process of converting traditional, often highly illiquid assets into digital tokens on a blockchain. This enables things like fractional ownership. You could own $100 worth of a commercial building. It promises vastly increased liquidity compared to traditional markets for these assets. And automated management via smart contracts, think automated dividend payouts, or collateral management.
So it's more than just NFTs of apes.
Hey, yeah, definitely more substantial. This isn't just a revival of the, NFT craze when people's digital art sold for $69 million. It's a strategic move towards tokenizing more substantial, less liquid, often regulated assets, corporate bonds, private equity, real estate, intellectual property rights.
And stablecoins play a role here.
A crucial one. MakerDAO's USDS, as we discussed, is explicitly shifting towards incorporating more RWAs, like U.S. Treasury bills, directly into its collateral structure. This is designed to appeal directly to institutional demand, providing a compliant yield-bearing dollar product on-chain that's backed by familiar, trusted assets.
What are the implications for traditional markets?
Potentially profound. Will major exchanges or investment banks eventually create tokenized versions of virtually all asset classes? It could fundamentally reshape global capital markets by removing intermediaries, speeding up settlement times dramatically, and increasing transparency.
And stablecoins facilitate this.
They're poised to play a crucial role as the payment leg for many of these on-chain transactions. Think about on-chain repo markets using tokenized treasuries. Stablecoins would be the natural way to handle the cash leg, enabling near-instant delivery versus payment settlement. This solves a huge, long-standing efficiency problem in traditional finance repo markets. JPM Coin, JP Morgan's internal token, is already being used by firms like Kinexes for exactly this collateral mobility and on-chain repo transactions. This trend really hints at a future where even the most illiquid assets can potentially be traded and managed with unprecedented efficiency and transparency.
Okay, while all these innovations are incredibly exciting, AI, RWAs, convergence, it's absolutely crucial for expert users to remain acutely aware of the associated risks. We can't ignore the downsides.
Never ignore the risks in crypto.
Despite all the promise, stablecoins and the DeFi ecosystems, they enable carry inherent risks. We've touched on some, but let's list them out. Smart contract vulnerabilities, general market volatility affecting even stable assets sometimes, liquidity issues in certain pools or protocols, and of course, the potential for depegging events.
Yes.
The infamous collapse of Terra USD, wiping out $60 billion, and even USDC's temporary depeg during the Silicon Valley Bank crisis serve as really stark reminders of these dangers.
Absolutely sobering examples.
And other risks include things like custodial breaches for centralized stablecoins, sophisticated flash loan attacks exploiting protocol logic, and even simple impersonation scams or fake stablecoins designed to trick users. So for the astute investor, it's just not enough to understand the upside. You absolutely need to understand the potential pitfalls.
Absolutely. Let's break these down a bit more because truly understanding them is paramount for anyone wanting to navigate this space safely, especially with significant capital. First, smart contract risks. These involve vulnerabilities hidden in the code that governs DeFi protocols. Things like reentrancy bugs, logic errors, inadequate access controls. The list goes on. This makes thorough audits by reputable security firms absolutely essential, and you should always check a protocol's history for any past vulnerabilities or exploits. A single bug can lead to a complete loss of funds locked in the contract. It happens.
Right, audits aren't guarantees, but they're necessary.
Necessary, but not sufficient exactly. Second, market and liquidity risks. Even when dealing primarily with stablecoins, you need to monitor the overall market dynamics and the specific protocol's health. Assess token liquidity within a pool or protocol before depositing large amounts. This helps mitigate potential slippage during trades or withdrawals. And diversifying investments across different protocols, different chains, different strategies is just basic risk management to avoid overexposure to any single point of failure.
Don't put all your stables in one basket.
Pretty much. Third, depegging events. We learned hard lessons from algorithmic stablecoins like Terra USD. They proved extremely fragile, often relying on complex, sometimes self-referential algorithms that can spiral in adverse conditions. $60 billion vanished almost overnight.
Catastrophic.
But even supposedly safe, fiat-backed stablecoins like USDC depegged by about 13% briefly during the Silicon Valley Bank failure. Why? Because a significant portion of its reserves were held at SVB. This showed that even regulated, fully backed stablecoins aren't entirely immune to shocks ripple through from the traditional financial system. Their reserves matter.
A crucial link there.
Fourth, custodial breaches. For centralized stablecoins like USDT or USDC, the risk is that hackers compromise the issuer's infrastructure. They could potentially gain access to reserves or, worse, find a way to mint unauthorized tokens, which would completely undermine confidence and value. This is why the mantra, not your keys, not your coins, remains so important for holding assets long-term.
Right, self-custody mitigates this specific risk.
Fifth, flash loan attacks. These are complex exploits, usually targeting DeFi protocols. Attackers use uncollateralized loans borrowed and repaid within the same transaction block to manipulate prices on DEXs or exploit logic flaws in protocols for instant profit. They require deep technical expertise, but can drain millions from vulnerable protocols in seconds.
Scary stuff.
Sixth, impersonation fake stablecoins. A simpler, but still dangerous risk. Criminals create tokens that look almost identical to legitimate stablecoins. Same name, same logo, hoping to trick users into interacting with malicious contracts or sending funds to the wrong address. Always double-check contract addresses.
Due diligence is key.
Seventh, concentration risk. This is more systemic. For example, reports suggesting USDT's peg relies heavily on just 6 arbitrageurs highlight a potential vulnerability. If those key players face issues or coordinate actions, it could impact the market. It also points to counterparty risk, even in a decentralized system.
Centralization creeps back in.
Eighth, regulatory concerns. From the regulator's perspective, they're keenly focused on consumer protection, ensuring adequate oversight of international providers, mitigating systemic risk if one stablecoin becomes too dominant, too big to fail, and preventing illicit finance. Regulatory crackdowns or new rules can significantly impact the market.
And finally,
Ninth, criminality and sanctions evasion. The unfortunate reality is that the permissionless nature of many decentralized blockchains and the lack of central operators mean stablecoins can be used by bad actors to facilitate illicit activity and evade sanctions. This is a constant battle for blockchain analytics firms, exchanges, and regulators.
it's an exhaustive list, and it really underscores the importance of vigilance, research, and maybe not putting your life savings into the riskiest strategies.
Definitely proceed with caution and understand what you're getting into.
So as things like enhanced security measures, better audits, formal verification, bug bounties, and maybe insurance protocols become more standard in DeFi, will they truly provide adequate protection against all these evolving threats? Or are we simply in a perpetual arms race between builders and breakers?
It's very much an ongoing arms race, I think. Enhanced security measures, multi-sig setups, MPC wallets, third-party insurance protocols like Nexus Mutual, they're all crucial developments and add valuable layers of protection. But they don't create impenetrable shields. New vulnerabilities are constantly discovered. Novel attack vectors emerge.
So no silver bullet.
No silver bullet. The fundamental challenge remains how regulation will effectively address that compliance void in truly decentralized systems, or the inherent difficulty of policing pseudonymous bearer instruments that can move globally without permission. This ongoing tension between decentralization's benefits, innovation speed, and the necessity of regulatory oversight and user protection that will continue to define the risk landscape for years to come. That's why, as you said, the mantra, not your keys, not your coins, particularly using hardware wallets for significant amounts you intend to hold, remains absolutely paramount for mitigating at least the custodial risk aspects.
Makes sense. And finally, one last, often overlooked area, even stable assets have tax implications that cannot be ignored.
Yes. Taxes. The inevitable.
Stablecoins, just like other cryptocurrencies, are generally treated as property for tax purposes in many jurisdictions like the U.S. This means they are subject to capital gains and income tax.
That's right.
Any gains or losses from their disposal or trade are generally taxable, and this includes transaction fees paid using stablecoins, even for those tiny fluctuations around the peg. Crucially, swapping one stablecoin directly for another, say USDC for DAI, is typically considered a taxable event, a disposal of the first one.
That last point catches a lot of people out. While stablecoins aim for price stability at $1, those small fluctuations, maybe you bought USDC at 0.9999 and sold or swapped it at 1.001, technically result in a tiny capital gain.
And those add up.
They can, especially with frequent trading or yield farming activities involving many transactions. It means meticulous tracking of all stablecoin transactions, recording the cost basis and proceeds for each disposal is crucial, even if the individual gains seem minimal. Cumulatively, they can add up, and failing to report them could lead to issues down the line.
So keep good records.
Absolutely essential. The Genius Act and other potential regulations might also reshape how platforms operate and how taxes are handled or reported in the future. We might see clearer guidelines or maybe even 1099-style reporting for more platforms eventually.
But for now, the burden is on the user.
Largely, yes. As stablecoins become more widely adopted, it's a valid question whether tax authorities will eventually simplify or standardize reporting requirements, perhaps with de minimis exemptions for tiny gains. Or will the complexity just continue to grow, basically requiring specialized crypto tax software or advisory services for anyone active?
Time will tell on that one.
For now, it's essential to report even small gains accurately to avoid future problems. And thankfully, services like CoinLedger, Coinly, and others exist specifically to help manage these complex crypto tax obligations, providing a necessary tool for any advanced or active stablecoin user. Don't ignore the taxman.
Sound advice. Okay, so we've really covered a lot of ground today. We've navigated this intricate world of advanced stablecoin strategies, from optimizing yield in DeFi and CeFi, to streamlining global payments, to the cutting edge of cross-chain innovation and the risks involved. We've explored how they're becoming financial rails, the institutional awakening, the regulatory hurdles, and the opportunities for the truly agile investor.
It's a dynamic space, that's for sure.
But here's something to maybe leave our listeners pondering. If stablecoins truly become the beating heart, as some say, of a programmable, resilient monetary system, a system capable of extending dollar supremacy in new ways, enabling autonomous AI agents, and simplifying finance on a global scale, how might our very concept of traditional money fundamentally shift in the next, say, 5 to 10 years?
Big question.
Will that line between digital currency and physical currency just blur entirely? And what new opportunities or perhaps unexpected challenges will that present for the truly agile investor, the one who embraces this evolution early?
We've laid out the landscape as it stands today, highlighted the tools, the strategies, the risks, and pointed towards the future trends. Now the deep dive continues as you, the listener, integrate these insights into your own strategic approach to this rapidly evolving world of stablecoins.